Joseph Samuel asks, how do sovereign gold bonds compare with gold ETFs? Are SGBs a better option?
Well, yes, I would say that investors who are looking to invest in gold, for them, sovereign gold funds appear to be a superior option to gold ETFs on a lot of counts. So let me talk a little bit more about them. Talking about returns, sovereign gold bonds offer a 2.5% per annum rate of interest over and above the appreciation in the price of gold, which these bonds would fetch. While in comparison to that, gold ETFs only fetch you the appreciation in the price of gold. So of course, there is a clear 2.5% extra return that you can make from sovereign gold bonds vis-a-vis the gold ETFs. That's one. Second is around the costs. So sovereign gold bonds really do not have any ongoing cost of ownership, while gold ETFs have an expense ratio of typically around 1%. So that's a cost that investors who remain invested in the gold ETFs have to pay. So there as well, SGBs trump over gold ETFs. Now the third aspect where SGBs are miles ahead of gold ETFs is the taxation, because in case of SGBs, the appreciation in the gold, the capital gains that you make on the appreciation in the price of the gold is completely tax free. You only have to pay tax on the 2.5% interest, which gets added to your income and gets taxed as per the slab system. In contrast to that, in case of gold ETFs, you have to pay capital gains tax on the price appreciation of gold that you achieve, and they are taxed as a non-equity capital gains. So there again, SGBs are miles ahead, as I said. Now the only aspect where SGBs trail behind gold ETFs is the liquidity, because in case of SGBs, liquidity is for all practical purposes unavailable in the first 5 years. After that, you can redeem them directly with the RBI, but in the initial 5 years, you can only sell them on a stock exchange. While the practical experience is that these bonds usually do not have a lot of liquidity on the stock exchange. So you have to live with a lower degree of liquidity in the first 5 years. Now, in contrast to that, gold ETFs, or at least some of them, have fairly robust liquidity. They trade in fairly robust volumes on stock exchanges. So in case of those gold ETFs, liquidity may not be much of an issue. So to sum it up, if for an investor for whom liquidity is not a big concern, then certainly SGBs look like a better option.